Wall Street gyrated to ultimately end sharply lower on Wednesday after the U.S. Federal Reserve delivered a 25 basis point interest rate hike, with the Dow, S&P 500, and the Nasdaq all closing down roughly 1.6%. The three major indexes at first climbed higher as Chair Jerome Powell indicated the Fed might pause its rate hikes due to turmoil in the banking sector.
We no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate.
But stocks headed south as deflated investors digested Powell's subsequent Q&A session, in which he reiterated the central bank's commitment to reining in inflation.
We're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve.
I believe this may be the last hike for good.
But Jimmy Lee, founder and CEO of the Wealth Consulting Group, believes Wednesday's rate increase will likely be the Fed's last.
My base case is that inflation's coming down, and the stickiest part of potentially inflation is wage pressures. And the signs of wage pressure coming down, I think, is another reason why the Fed just may stop now.
Meanwhile, shares of beleaguered First Republic Bank slipped more than 15% in volatile trading amid worries it may need to downsize or seek government support. Among other movers, retail darling GameStop surged 35% after posting a surprise fourth-quarter profit. And Nike dropped nearly 5% a day after the sports apparel maker raised its full-year revenue outlook but warned of margin pressures.
Amid recent turmoil in financial markets spurred by the collapse of two U.S. banks, Fed Chair Jerome Powell Wednesday announced an interest rate hike of 0.25 percentage point and indicated the Fed was on the verge of pausing further increases, as Powell warned that stress in the banking industry could trigger a broad credit crunch with significant implications for the U.S. economy.
We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate.
The Fed's relentless rate hikes to rein in inflation are among factors blamed for the biggest banking sector meltdown since the 2008 financial crisis. Policymakers have stressed the turmoil is different from the crisis 15 years ago, saying banks are better capitalized and funds more easily available. Powell insisted the system was sound after the spate of actions that the central bank and other regulators have taken in the last 2 weeks.
These actions demonstrate that all depositors' savings and the banking system are safe. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools, as needed, to keep it safe and sound.
But while deposits might be safe, the recent banking dysfunction could hurt consumers in other ways. As banks pull back, loans might be harder to come by. Christian Ledoux is a director at Cap Trust.
The banking situation is actually disinflationary, as banks are going to be responding to this by loaning less and being a little bit more conservative.
That could help the Fed back off its inflation fight. This is quite a shift from a few weeks ago when a series of stronger-than-expected economic reports had raised concerns the Fed would continue lifting rates longer than anticipated and to a higher level.